Let's go back to the beginning of this whole global financial crisis. It started with the collapse of the US subprime mortgage market, but we know that that was really just a symptom, not the underlying cause of a much bigger problem right around the world. So what was actually going on at that time?
It began actually quite some time ago. Trouble is that markets have been getting ahead of themselves for a very long time. That tends to be true always when you have a long boom. In Australia we had a very long boom by the standards of the past, but so too did the world. I mean, the world in recent years saw the best burst of global growth since the 1950s. And under those circumstances, markets got very excited, aided by the fact that the cost of money went lower and lower. And that's the central thing. You know, when the cost of money goes down, the value of stuff goes up. You know, houses, shares, office blocks, shopping malls, all those sorts of things. And we saw a long period of very low official interest rates around the world, particularly led by the US in the wake of the dot-com crash. But private markets themselves added to that. At any given time, when a company borrows, when a person borrows for housing or other purposes, there's not just the official cost of the interest rate, but the margin that markets charge above that, and they charge it for risk. And increasingly, all around the world, they stopped charging for risk, and the value of risky stuff kept rising. So, all these banks held assets which were, for example, loans to people in the US for housing that they could never afford. And that simply blew up first. It was the craziest valuation on a key asset, but it was happening all over the world. You could see it on the values placed on shopping centres in Australia, or the private equity phenomenon of recent years, where deals kept getting done and kept getting done. If the cost of money keeps falling and the value of stuff keeps going up, then almost any deal, even a bad deal, makes money. So the next deal comes along and it keeps pumping up this boom in markets. For the average economy around the world, the wealth of the average family, 4 or 5 times its post-tax income. But you saw that notably increase in a number of nations around the world in the last decade or so. In Australia, that ratio went to almost 8 times, the wealth, net wealth of the average family, 8 times their post-tax income. But you saw it all over the world, and it couldn't last.
It seems to me the whole thing was a bit like pass the parcel. Who was left holding the baby when the crash finally came at the end?
Yes, now, and again, subprime mortgages in the US are a good example. Remember, not the key cause, but a good example. Now, those mortgages were evil. Right? The people who were selling them must have known in many cases that the people buying them never had a chance of paying them back. And yet, although evil is a great adjective to apply to it, it's not the main adjective. The main adjective is dumb. It's at the end of the process, somebody is left holding the assets. Who was left holding the assets? By and large, it was not just US banks, but you see all these supposedly very smart, very sophisticated, carefully risk-managed financial institutions around the world. They held them. They blew up. And sure, it was a local council in Victoria and a local council in Norway and a university from wherever else. But mostly, the banks blew up themselves.
Until reasonably recently, the government was still saying that they thought Australia could avoid a recession. Obviously, they got that wrong. How did they get it so wrong? How did governments right around the world get it so wrong?
The key dividing line for the world came when the global banking system collapsed in late September.
The collapse of Lehman Brothers.
Yes. Now, Lehman Brothers happened to be the trigger. Something was going to do it. But what made Lehman Brothers so pivotal in the process was that banks are forever lending money to and fro overnight. Money makes the world go round. Companies that are eminently profitable will, from time to time, need money. It might be a payroll bill or whatever else. They'll ask their bank. The bank may not themselves have it, so they ask another bank. And it is this quiet and typically very efficient bit of infrastructure, global credit markets, the global banking system that whirs away in the background and money's flying around all the time, except when Lehman Brothers was allowed to collapse, banks in America and around the world asked themselves, well, do I really want to lend out money for 28 or 48 hours to another bank? Because I'm not sure that they're going to be there in another 24 or 48 hours. And also in current circumstances with very worried customers, I have to face the possibility of a line of customers outside my front door tomorrow morning. I'm going to hang on to the money for that purpose as well. And the collapse of trust and confidence in global banking markets meant that they broke down. And money makes the world go around, and if money is not going around, no money, no fun. And that hit economies all around the world very fast, and recession is infectious, swept the globe. Now, the key for the world was the breakdown in global banking markets. Key for Australia was when China got caught up in this, because Australia has had a brilliant benefit and boost from China's economic strength in recent years. In particular, not so much the amount of iron ore and coal and so on that they're buying, but the price that those things were going at. Now, iron ore and coal are good examples. I mean, you're talking about effectively the two largest export earners Australia has. This is what we sell to the world. And those two in particular are mostly sold on annual contracts, and the price runs from 1st of April to 1st of April. And in April 2008, coke and coal prices tripled and iron ore prices almost doubled. So the world, China was still going very strongly. The world was paying us the biggest pay rise we'd ever seen. And I, and clearly the government, thought that Australia had 12 months of protection up its sleeve from what was happening internationally. Proved to be wrong, first because global banking system broke, second because China rapidly got caught up in it, partly for Chinese reasons, but partly also because of what's happening in the globe. And that, China's slowdown is Australia's recession.
So what you're really saying is in another month or so, in April, when those contracts are renegotiated, there's another big crunch coming.
Come the 1st of April, and often these negotiations at difficult times, and these are difficult times, will pass the actual date, but the prices will get backdated to the 1st of April. Come the 1st of April, Australia's national income takes a real hit from this. You look at the nominal value of output in the economy, not quite national income, but close enough to that. It grew in the 12 months to September 2008, that's the latest information we currently have, grew by 10.4%. National income leaping ahead at effectively a record rate. In the 12 months to September 2009, it will fall. National income will fall in much the same way it did in the recession in 1991. Now, it's not the same as the recession of 1991. The key was, for us this time, the China boom gave us stunning coal and iron ore prices that's helped our incomes, and particularly our profits, till just recently. Come the 1st of April, and the party is truly over.